We are walking into a global liquidity crisis, and the markets have not even begun to price it in. That is the latest warning from Jim Rickards, one of the most connected financial minds in the world, in his most recent breakdown of the Iran war and what it means for the global economy. If you do not know who Rickards is, you need to. He advised the Pentagon and US intelligence community on global finance. He was the facilitator of the first ever financial war games conducted by the Department of Defense. He was personally involved in the 1981 Iran hostage crisis negotiations. He was a principal negotiator in the 1998 long-term capital management bailout that prevented a systemic collapse of Wall Street, and he helped build the original petrodollar system while working with the Nixon White House and Henry Kissinger. He is also the New York Times best-selling author of Currency Wars and the Death of Money. In this interview, he warns that the ceasefire is already falling apart, that the two sides have not agreed on anything, that a global recession is already baked in, and that a full-blown liquidity crisis is building beneath the surface. Here is exactly what he said.
Trump has a plan. Iran has a plan. They don't match. They don't sync up at all. So what are we going to talk about for the next 10 days or 2 weeks? Well, I think talks are good. I'm all for that. I'm all for the ceasefire. But it's kind of hard to be optimistic that they're actually going to resolve this. No, that was pretty much pure propaganda, what Hegseth said. So, Michelle, to your question, have we achieved our military objectives? What were the military objectives? I mean, they never really articulated them at the beginning.
Objectively, to significantly downgrade missile capabilities. I believe that has been achieved.
Yeah, we destroyed a very high percentage of their missile launchers. They had 10,000 missiles. We probably destroyed 3,000 or 4,000. They expended or shot, several thousand. They probably have 3,000 left, so I don't think they're out. We destroyed a lot of launchers, but the launchers are mobile. They tend to be hidden. As far as air supremacy, we tell that to the pilot of the F-15 who got shot down the other day. There are 3 Marine Expeditionary Units, mobilization of the 1 Brigade of the 82nd Airborne. Some estimates 10,000 additional U.S. troops all mobilized. And what would they do? They could take Kharg Island, which 90% of Iran's oil goes through Kharg Island. Iran has a fairly shallow coastline. Kharg is about 25 miles offshore. The water around it is deeper. If you take Kharg Island, you control Iran's oil output. The choke point of the choke point, if the Strait of Hormuz is a choke point, Kharg Island is Iran's choke point. Could we do it? Probably. But that's a pretty large amphibious operation, airborne. You then become a target, right? Because Iran still has the drones. They still have missiles. Do they start bombarding our troops there? But they've already said today, this was reported in the Telegraph, that they start to close the Straits of Hormuz. Well, they did say we're closing the Straits of Hormuz because you, the United States and Israel, have not lived up to your side of the deal. That could relate to the fact that Israel said, we agree to a ceasefire with Iran, but we're going to continue to attack in Lebanon, attack Hezbollah. Iran may have said, well, no, stopping attacks on Hezbollah was part of our deal, and if you're reneging, we're closing the Straits. So this thing is as fragile. It could be over by tonight.
So there is Jim Rickards laying out in plain terms why this ceasefire is not what the headlines are telling you. The two sides have not agreed on anything. Iran is already threatening to close the strait again, and 10,000 US troops are mobilized for what could be an amphibious assault on Iran's main oil export hub. Now, let's look at what the numbers are telling us right now, because the real-world data is confirming everything he just described. Brent crude has spiked above $112 a barrel in recent days. The dated Brent price, which is the benchmark for actual physical oil deliveries, hit $144, the highest ever recorded. And even with this ceasefire, the EIA is warning that Middle Eastern producers have shut in up to 9 million barrels per day. That is not just a disruption, that is a historic supply shock. The IEA has warned this crisis could be worse than the oil shocks of the 1970s. Analysts at Macquarie Group have said that if the war continues through June, oil could spike above $200 a barrel. Gas prices have crossed $4.16 nationally. In California, it is approaching $6. In parts of Los Angeles, stations are posting $7 a gallon. Diesel is forecast by the EIA to peak above $5.80 this month. And as Rickards points out, this is not abstract. If you are paying $5 a gallon at the pump instead of $2.50, that money is coming directly out of groceries, entertainment, clothing, and everything else that drives consumer spending. 86% of Americans now say gas prices are their top financial concern. The equity markets are starting to crack. The S&P 500 is down 4% on the year. All three major indices have broken below their 200-day moving averages. Moody's Analytics puts the probability of a US recession at nearly 49%. Goldman Sachs has it at 30%. The US economy grew at just 0.7% in Q4 2025. February payrolls contracted by 92,000 jobs. And here is the part that matters most. Rickards is warning that none of this has been properly priced in yet. The markets are still operating on a narrative that this ends in 2 to 3 weeks. That narrative has been running for 9 weeks. Here's what he says about that.
So there's actually a global dollar shortage and the beginnings of a global dollar liquidity crisis. And the reason people are selling treasuries is not because they hate treasuries. It's because they need the dollars to prop up their banking system and pay off bad debts. So we're not looking at de-dollarization versus other currencies. We are looking at increases in gold. You're absolutely right about that. But the bigger play is there's a global dollar shortage. We may be walking into a buzzsaw in terms of a global liquidity crisis. And by the way, Michelle, that has been happening for a while. That's been playing out for a couple of years. The fact that you've got a dollar liquidity crisis, a private credit meltdown, and a war in Iran all at the same time is extremely concerning. And we could be looking at best, a recession and perhaps something much worse. Strait of Hormuz was closed almost the day the war began, but there was a lot of oil and natural gas and fertilizer, for that matter, in transit that was already outside the Straits of Hormuz. It was unaffected by the closure of the Strait of Hormuz. That can take 2 or 3 weeks to get to South Korea and Japan and India and the ultimate users. So the ships were underway. They were still delivering. There was nothing about closing the Straits of Hormuz that affected the supply immediately because it was already on the way. But now we're 7 weeks into this. Now the supply has dried up. There are no tankers underway. And it's really just now, as we speak, that the shortage is going to kick in. Oil, natural gas, and fertilizer, helium in transit, that has dried up because those vessels have delivered, and now is when the danger really kicks in. Not to mention the infrastructure damage. Even if you had peace, love, and understanding in the Persian Gulf tomorrow, I don't expect that, by the way, but even if you did, the damage to gutters, liquid natural gas facilities is extensive. That's going to take months, perhaps even longer, to repair. So this economic damage is there with or without a ceasefire, and the ceasefire itself is incredibly shaky. So right now, my view of the stock market is that stock markets, and to some extent bond markets, have not discounted what we're talking about. Well, how many analysts on Wall Street have you heard saying, well, we think the war will be over in 2 to 3 weeks? But they've been saying that for 9 weeks. I mean, that's my point. It's like, how many times do you say 2 to 3 weeks and the 3 weeks go by and you're still fighting when you're like, oh, you know what? Maybe this is going to last for years. Maybe this damage is going to take 6 months to a year to repair. It's just not like throwing a switch. You can't turn them on just because the oil shows up. Even if peace broke out tomorrow, which I don't expect, the damage has already been done. It's just the markets haven't reflected that yet.
So there is Rickards making the point that almost nobody on Wall Street is willing to say out loud the damage is already done. Even if peace broke out tomorrow, the economic consequences are locked in. 7 weeks of closed shipping lanes, infrastructure destroyed, refineries shut down that cannot be restarted with the flip of a switch, and the supply pipeline that kept the world running for the first few weeks after the strait closed has now been fully consumed. And this is happening on top of a system that was already under severe stress. The commercial real estate collapse is accelerating. In January 2026, the delinquency rate on CMBS office loans hit 12.34%, the worst since tracking began in 2000 and worse than the 2008 financial crisis. $930 billion in commercial real estate debt is maturing this year. Office vacancy nationally is between 17 and 18%. In Denver, it is above 36%. A 50-story tower in Manhattan defaulted in January. The regional banks that loaded up on these loans are now exposed. On the consumer side, CNBC this week interviewed Americans at gas stations across the country. People in Los Angeles paying $7 a gallon. A contractor from Virginia calling the price difference insane. A retired woman in Nashville saying she would leave town if she had to cover her own fuel costs. Moody's confirmed that the top 10% of earners now drive nearly half of all consumer spending. Deloitte says the bottom half of the economy is effectively already in recession, and the Fed cannot intervene. Rickards makes the critical point that the inflation we are seeing is not driven by money printing, it is driven by supply shortages. The Fed cannot fix a supply shock by cutting rates, and they cannot stimulate growth without making inflation worse. The system is stuck. But there is one asset Rickards says is going significantly higher from here, and the math he lays out is hard to argue with.
$10,000 is still a realistic estimate. I said some time ago it was 5. It got to 5, got smashed down a little bit, kind of working its way back to 5,000 in stages. But yeah, it'll go along the kind of inflation that we talked about. Central bank demand is not going away, so supply is flat. Central bank demand is going up. Safe haven asset attractiveness of it is going up. So that will continue to drive it. And then I did the very simple bit of math where I pointed out that if you use $1,000 increment as a marker, each $1,000 increment is easier than the one before because you're working off a higher base, so it's a smaller percentage gain. So going from $4,000 to $5,000 an ounce is a 25% increase. That's a heavy lift. But going from 9,000 to 10,000 is only an 11% increase. That's much easier. You kind of struggle, or it'll take time to get to 6 or 7, but you're going to go 8, 9, 10 really quickly. I would say we have a global monetary problem anyway, but the war makes it worse because not just the increase in the price of oil, but the supply. The U.S. is not going to run out of oil. We got plenty. But the rest of the world, South Korea, Japan, China, they're going to see supply shortages. They already are. The price of gold is going up, and the percentage of global reserves in gold is going up. It's what saved Russia during the Ukraine war. We froze 300 billion of their treasury securities, but Vera Nabiullina, who's the head of the Central Bank of Russia, had put 25% of the reserves in physical gold. We couldn't freeze that. And in fact, when the price of gold started going up from $2,000 to $5,000 an ounce, Russia made as much mark to market on the price of gold as they lost on the frozen treasury. So that was a pretty smart move by her.
And so wouldn't this conflict accelerate other countries saying, I'd rather have gold than dollars?
Yeah, I think that's absolutely right.
So there is Jim Rickards laying out the full picture, and the takeaway is sobering. The ceasefire is already cracking. The two sides have not agreed on a single point. 10,000 US troops are mobilized for a potential amphibious assault on Iran's oil hub. The supply of oil, natural gas, and fertilizer that kept the world running for the first few weeks of this war has now been fully consumed. Even if peace broke out tomorrow, the infrastructure damage alone will take months to repair. And beneath all of this, a global dollar liquidity crisis is building. Countries are selling treasuries not because they want to, but because they need the cash. Private credit is melting down. Commercial real estate defaults are at all-time highs. The consumer is tapped out. And the Fed cannot cut rates because inflation is being driven by a supply shock, not money printing. Gold is above $4,650. Silver is above $75, both up massively year on year. Rickards sees gold reaching $10,000 and says the math gets easier the higher it goes. Central banks around the world are accelerating their move from dollar assets into physical gold. Russia already proved that strategy works. The question is no longer whether this is serious. The question is whether the markets catch up to reality before it is too late. Stay informed, stay prepared. And make sure you are subscribed because we are tracking every development as this unfolds.